Initial public offering, IPO, explained in 3 minutes. An initial public offering, IPO, is the process by which a private company offers its shares to the public for the first time. This marks the transition from a privately held company to a publicly traded one, allowing individuals and institutional investors to buy shares on the stock market. What is an IPO? An IPO is a way for companies to raise capital by selling ownership stakes in the form of shares. Before an IPO, the company is privately owned, typically by founders, early investors, and venture capitalists. By going public, the company can access a larger pool of capital to fund growth, pay off debt, or invest in new projects. Why do companies go public? Raise capital. An IPO provides significant funds that can be used for expansion, innovation, or other strategic goals. Increase visibility. Being listed on a stock exchange increases the company's profile, attracting more investors and customers. Liquidity for investors. Early investors and employees can sell their shares, realizing profits for their initial investments. Currency for acquisitions. Publicly traded shares can be used to acquire other companies or assets. How does an IPO work? Preparation. The company hires investment banks to act as underwriters who help determine the value of the company, the number of shares to offer, and the share price. Regulatory filings. The company files a registration statement with regulatory authorities, like the SEC in the US, to disclose financials, business risks, and plans for the raised capital. Marketing, roadshows. The underwriters present the IPO to institutional investors through roadshows to generate interest. Pricing and launch. The company sets the final share price and launches the IPO. Shares are sold to institutional and retail investors and begin trading on the stock exchange. Benefits of an IPO. Access to capital. Enables the company to secure funding without taking on debt. Improved credibility. Public companies are often viewed as more stable and trustworthy. Employee incentives. Stock options and share ownership can be used to attract and retain top talent. Risks of an IPO. Market volatility. Share prices can fluctuate significantly, especially during the initial trading days. Increased scrutiny. Public companies must disclose financials regularly, making them subject to greater public and regulatory oversight. High costs. Preparing for an IPO involves significant legal, accounting, and marketing expenses. Real-life example of an IPO. When Facebook went public in 2012, it raised $16 billion, valuing the company at over $100 billion. The funds helped Facebook expand its business and make significant acquisitions like Instagram. An IPO is a major milestone for a company, offering growth opportunities while opening it up to public ownership and scrutiny. It's a key event in the financial world, connecting private businesses with global investors.